As we mentioned earlier, this jobs report would be our lead story on any other day, with payrolls blowing the doors off. But after everything we have seen in the financial markets, and knowing that President Trump has now put forth his plans for tariffs taking effect tomorrow and next week, are these data already old?
No, I don't think the data are already old. I mean, look, we're very pleased with the jobs report that we got. The economy created 228,000 jobs in March. That's roughly twice the amount of jobs that it created in either January or February. In fact, it was such a good month that it was, in fact, the fourth best month in the last 2 years for job creation. That's pretty spectacular. And, in spite of some headwinds that folks thought would be material headwinds, the president has acted very swiftly and forcefully to close the border and to prevent the surge of, and to stem the surge of illegal aliens coming into this country. And lots of folks said, oh, that'll be bad for job growth, right? That'll be bad for job creation. Well, this report proves that that might not necessarily be the case. And so what the report shows is the economy is continuing to grow in spite of the president's variety of policies, and it's a good sign.
Mm-hmm. Well, but this report, Mr. Chairman, is by nature backward-looking. I think the concern financial markets have today is about the forward-looking picture and what the economy is actually going to look like in light of these severe tariffs that are being implemented starting tomorrow, the layoffs of federal workers that the Department of Government Efficiency is pursuing. How can you guarantee the labor market will hold up in the face of those challenges?
Yeah, thanks. So look, the president acted with historic scope and speed to address what was a decades-long festering problem that had been eroding our competitiveness and eroding our prosperity and eroding our economy. And so, of course, there's going to be some market volatility on the back of that. Of course, there's going to be some adjustments on the back of that. But on the end of it, things are going to be materially better. And I'll tell you why. Not only will the tariffs incent reindustrialization in America and companies coming back to build in America, but there's also two other legs to the stool that are of significant importance. There's the deregulatory agenda, and then there's the tax agenda. And both of those are profoundly stimulative for the economy. And one point that I like to make is that imports are only 14% of the economy. The other 86% of the economy is affected by the entirety of the agenda. And so that's tax and regulation, and both of those are going to be very important.
I'd like to ask you, Stephen, about the comments that we heard from Jay Powell a bit earlier today. The Fed chair had this to say about the potential impact of President Trump's tariff regime. Listen.
While uncertainty remains elevated, it is now becoming clear that tariff increases will be significantly larger than expected. And the same is likely to be true of the economic effects, which will include higher inflation and slower growth. The size and duration of these effects remains uncertain.
Stephen, our Edward Harrison writes that unless the labor market data deteriorate precipitously, the bond market is going to have to reverse some of its post-Liberation Day rally, taking stocks down further in the process. The jobs report today is bad news for stocks and bonds, he says, because we're not going to see lower interest rates anytime soon. And the chairman today suggesting that he is in no hurry, even as President Trump puts on Truth Social that this would be the perfect time to cut interest rates. What is your message to investors when it comes to rates here against the backdrop of tariffs?
Sure. So first, let me be clear that, I'm not going to tell the Fed what to do, but I will point out that we lived an experience of tariffs in 2018, 2019 during the president's first term, and there was zero macroeconomic evidence whatsoever that tariffs had any material inflationary impact. In fact, the Fed wound up cutting rates on that event. So I think it's important to understand.
But we're talking a different scope and scale now, Mr. Chairman. The tariffs from the last administration are nothing like what we're seeing now.
Yeah, the president has acted with historic scope and speed. I agree with that. But we also have to appreciate what's going to be happening on the tax and regulatory front. And I think that one of the most powerful things for determining the supply side of the economy is the regulatory environment. If prices are high and increasing because there's not enough stuff, the best way to address that is to make more stuff. That means getting government out of the way, letting firms invest, letting firms build, letting firms produce. And if you make more stuff, you can address not only inflationary pressures, but actually bring some prices down. And I think that that's powerful and arguably much more powerful than any effects of tariffs.
But what is the actual lag time between seeing a lesser regulatory burden, seeing tariffs that maybe would incentivize U.S. manufacturing to invest in that capacity, the lag time between the decision to do that and the actual capacity coming online and whatever employment or what have you will come with it? This isn't going to be an automatic thing, right, Mr. Chairman?
Yeah, thanks. So that's a great point, which is that the regulatory process and taking away those regulations is a legal process, and that takes some time. And the president has made historic progress in the first 2 months peeling back regulations, but there's still so much work to do. And it'll take some time for us to get that through. And so that's, maybe this is part of why there's market volatility, because implementing the totality of our plans will take some time. Congress is working on the tax package as we speak. It will take some time to pass it. It will take some time to implement it.
We're hearing a lot of concerns about a recession. Money managers are pointing their trades toward a recessionary environment. And JP Morgan today increased odds for its recession forecast to 60%, up from 40. Stephen, what are yours?
Yeah, I'm not a professional forecaster, so I don't necessarily have odds. But what I will say is what I said a moment ago, which is that imports are only 14% of the economy. So you really have to think of, really, really huge, really enormous changes sort of shaking through those things to get to the place where you think a recession is likely as a result of something like this. And as I said before, I think that the president's pro-growth policies on the regulatory front, providing further tax relief to American families, extending the tax relief of his 2017 Tax Cuts and Jobs Act, I think all of that is profoundly supportive of growth. And I think there's maybe a little bit too much focus on risks from what's going on right now, and not enough focus on the pro-growth policies that are
well, we're
being
certainly
implemented
focused
now
on
in the pipeline.
Wall Street. I understood. I don't mean to interrupt, sir, but there's a great worry about the negative wealth effect. This market is in free fall right now. We could continue this next week unless there is some change here in the news cycle as we hear about additional retaliatory tariffs. At what point does this drag consumer spending with it?
Yeah, so look, you're right. There can be some wealth effects. There will be some wealth effects. There will be, there will be ramifications of that stuff. But like I said before, we have to balance that out against the totality of other stuff going on in the policy agenda, the totality of the other strong drivers of economic growth. One point that I've made a lot is that the Biden administration's last 2 years, almost 3/4 of jobs that were created were in government and government-adjacent sectors, and that's profoundly unsustainable to have the government gravy train driving the economy. In the March jobs report, that number came down from almost 75 in the last 2 years of the Biden administration to just about 40, right? So that's a very material decline, and this is part of reconfiguring the economy from a government-driven growth engine to a sustainable, durable private sector growth engine, and this is going to continue.
As we consider the growth outlook, keeping in mind that you did just tell us, Mr. Chairman, that some of this will take time to materialize in terms of the stimulative efforts of this administration, whether legislatively or otherwise, if the Federal Reserve were to decide that it has to prioritize inflation, and if inflation persists and they don't want to cut rates, but we do see a material downward shift in growth or in the labor market, is there a lever that the White House is going to be able to pull more immediately to try to offset those effects if the Fed can't do both at the same time?
Yeah. So again, I'd point you to the forthcoming tax legislation that's being worked out on the Hill, and I think that will allow the president to provide profound tax relief that will be excellent for American families, American workers, American firms.
Well, going forward, Mr. Chairman, I wonder what's going to happen in terms of messaging to this market. Are we going to hear more from the administration, from the President of the United States, from yourself, when it comes to the dollar, when it comes to investing in the stock market in the United States? I know that frequently the refrain is we're seeing companies invest in America, but how about in our financial markets, where we've seen, I believe, a half dozen IPOs today delayed, some of them pretty large. We're hearing from some major firms planning to go public as soon as next week that are putting those plans on the shelf. What does the administration tell them?
Yeah, so I'm not gonna comment on specific companies and IPOs, but I will say what I said before, which is that of course there's going to be some market volatility on the back of the president's historic actions. But I also want to redirect you again to what we can do. And so, the tariffs are designed to redress the emergency of trade deficits, but there is a nice side effect, which is they raise a lot of revenue. And if you use that revenue not only to extend the historic tax cuts from 2017, but to provide further tax relief for American families while deregulating the economy and making it easier to invest, build, hire in America, you have the recipe to create an economic boom, wherein America is much more competitive because of the tariffs. It's much more competitive because lower taxes, households, firms, workers keep more of the money they earn every week, and they spend more of it, they save more of it, they invest more of it, and you get the government out of the way so they can build and invest and make factories. And that is the recipe for an economic boom. And if we keep at it, we can create a really great environment for firms to invest and hire, and that will, in the end, in the long run, drive the financial markets.
The other thing that tariffs, you would think, at least traditional economic theory would tell you, would lead to is a stronger dollar, and yet that's not what we've seen in the immediate aftermath of the announcement of these, Mr. Chairman. How concerned are you about a period of sustained dollar weakness?
Thanks. So, look, my view, as I've expressed before, is that classic economic analysis would say that the burden of any economic policy, whether it's a tax, a subsidy, no matter what it is, falls on what economists would call the more inelastic party, but I think is easier for other folks to understand as the more inflexible party. And the example that I keep giving is if you're looking to buy a house and the town that you're looking in raises its property tax rates and you're flexible, you can just look at the next town over. You can change your behavior to avoid the burden of the tax. The person who's selling the tax can't move his house across town lines, so he's got to eat the property tax and lower his selling price. And in that way, the burden of the tax fell on the person who couldn't move his house. And the same is going to be true in international trade. American consumers are flexible. We can make stuff here at home. We can change the countries from which we import. We can stop importing from a country with a high tariff rate and start importing from a country with a low tariff rate that treats us better, that is a better trading partner with us. And that ability to change our consumption patterns, whether to move it home into home production or among different countries, makes us more flexible. By contrast, installed factories in China, they've already spent the capital, the factories are stuck on the ground, the workforce is already trained to build products aimed squarely at the U.S. consumer markets. Those cannot move. So in the long run, other countries, the tariff countries, will end up bearing the burden of the tax, of the tariff. Now, there's a couple ways that can happen. In 2018, 2019, it happened through the currency, but it need not happen that way again. It could happen that way. It doesn't necessarily have to happen that way. There are plenty of other ways they can end up bearing the burden of the tax. It could happen through reduced selling prices.